Ooh, do we have a lot to talk about in this video here today? There's stocks crashing all over the place. I got to give my opinion on these, what's going on with these particular stocks. And these are a lot of big name companies too we're talking about. Right off the bat here, by the way, hope you guys enjoy this. As always, make sure to subscribe to the channel. Right off the bat here, let's talk about Shopify. Shopify down a massive 18% today. Shopify. This just goes to show there's no safety really in the stock market at this point in time. We watch Netflix drop like a rock. We watch Meta, right? FB drop like a rock. We watch PayPal drop like a rock. We watch Shopify drop like a rock. Like, these are some of the biggest companies in the world, some of the biggest market caps, and they have just, fallen off a cliff, to be quite frank. Shopify, I mean, keep this in mind, okay? What did we see with Netflix? What did we see with Meta? What did we see with PayPal? Other, what I would call mega cap companies that went down massively on their earnings. Well, those stocks didn't bottom the day after their earnings. It actually took, a lot of those stocks still haven't bottomed yet. And so when it comes to something like Shopify here, could this one go down more over the next several trading days, over the next several weeks? Absolutely. There's no doubt about it. I mean, you just look at the trends. A lot of these stocks, they're not bouncing back quick. In the past, the market, at least, basically after we went through the Rona crash, it was like if a stock dropped big, it got bought up quick. And the next thing you know, within a matter of days or a couple weeks, it had reached its bottom and it was up and away, right? And we're just not seeing that in this sort of market at the given time. And so with something like Shopify, you got to keep this in mind. We're going to look at the numbers here in just a minute. By the way, that P's all screwed up basically off of a one-time thing. They're not that profitable. If you look at their forward P, it's in the 150-ish, 175 range that analysts have for this company. So believe me, if Shopify was a true 27, okay, that'd be good. But they have a one-time adjustment that's basically just kind of helping them out short-term with the numbers. But yeah, when it comes to Shop, this one's just been hit hard, right? As far as numbers, revenue increased 41%, very strong to 1.38 billion. Analysts had projected 1.34 billion. So that's a nice number there. Profit, excluding some items, was $1.36 a share, compared with analysts' average estimate of $1.26. Once again, good number there. But when you're Shopify, the expectations are like through the roof. Gross merchandise volume, the value of merchant sales flowing through Shopify's platform, increased 32% in the fourth quarter from a year earlier to $54.1 billion. Analysts on average had estimated 52.6. So it's a nice number as well. I mean, these numbers are pretty darn good, but there's always a but, right? Basically, as far as guidance goes, Shopify said for the full year 2022, they expect year-over-year revenue growth to be lower in the first quarter of 22 and highest in the fourth quarter of 22. This is a little concerning here, year-over-year growth revenue to be lower in the first quarter. Basically, that's guiding for, a weak first quarter, essentially. We do not expect the Rona triggered acceleration in e-commerce in the first half of 2021 from lockdowns and government stimulus to repeat in the first half of 22. Basically, what Shopify is saying is we expect a weak first 6 months of the year, okay? And especially the first quarter of the year. And so no one likes to hear that, especially not in this market that is driven by fear right now. If you all of a sudden have something like that to say, it's devastating to you, and especially if you're, let's call it a company that has a huge PE on it, a huge forward PE. Shopify said it plans higher sales and marketing investments as well, $200 million in capital spending in 22. In addition, Shopify had nearly $7.8 billion of cash on its balance sheet, okay? So balance sheet's phenomenal at Shopify. Business is phenomenal at Shopify. But it's a super high valuation company. And when you start talking about, first half of the year, a little shaky, in this sort of market that's fear-driven, it's not good. Now, keep this in mind, okay, which Meta still hasn't found its bottom yet. And hopefully, eventually it does. But with Meta, they've been hurt bad from the change of iOS. And now Google's possibly going to do the same thing, okay? This matters in a big way for Shopify. And the reason it does is Shopify is a business model, and then we got to get to all these other stocks, okay? Shopify is a business model that, what do a lot of Shopify stores count on? They count on FB and they count on Instagram, okay? And so if you can't get as much data and you're contemplating starting a Shopify store, Well, your life just got harder. It's going to be harder for you to reach the revenue numbers you need to reach and the profitability you need to reach, because no one's going to do Shopify stores if they can't make money, right? And so this is some factors to kind of keep in mind. And those small businesses that a lot of times use Shopify, if they can't get as much data from FB, that's going to hurt their Shopify business and they may not be as inclined. Now, the good news is Shopify's branched out over the last few years and become more than just, a micro business company and a small business company. And so that's good for Shopify. But still, at the end of the day, you got to keep in mind this does affect growth rates. And when you have these insane expectations for growth rates and you have anything that hurts it all of a sudden, it hurts your business model. And so I think that's something a lot of people don't factor in. Shopify really built its business on the back of Facebook and Instagram, okay? And so always keep that in mind, that they can still put up some great numbers, but as long as Meta's hurt, it does hurt Shopify at least a little bit indirectly and directly as well, okay? Not just, a lot of people just don't think about that and even realize it, okay? And by the way, FB, yeah, it should find its bottom soon, but it still hasn't found it yet. And that's incredible. I mean, the P's gone insanely low now. Price to sales ratio looking the lowest it's ever looked for that company. Incredible. I do have one stock here that's actually really, really good today. Actually, I got two stocks that are really good today. This is one of those stocks, and then we got a bunch of stocks that have crashed. Corsair Gaming, CRSR. Good day for CRSR. By the way, this stock was just in the $17 range back on January 24th when the market was just tanking. So basically, they're getting in the S&P 600 small cap. That's good. It's going to put a better base around Corsair. It's going to give it more attention. It's going to give it, more people have to buy Corsair stock now. And so overall, there's just really good news for Corsair's stock price. It doesn't change anything with the fundamentals of Corsair's underlying business model. No. By getting in this S&P 600 small cap, it changes nothing for the business, the fundamentals of the business. However, it is a big change for the stock price. It is a great thing for the stock price. It's one of the best things that could happen to Corsair, honestly. And for that reason, I can understand why the stock's up 10%. And don't be surprised if Corsair has a great next year. Despite fundamentals, which fundamentals are really strong with the company, but honestly, it doesn't matter the fundamentals. As long as they just have a decent year in 22, the stock price is likely headed up in a pretty significant manner because of this inclusion. And so overall, I'm very, very happy about this, obviously. Now, in terms of getting an SP 500, Corsair is not getting there anytime soon because you pretty much got to be like 10 billion and up, if I recall, market cap to get in the S&P 500. So Corsair is not going there anytime soon, but this is a massive step getting an SP 600 small cap. And this is something I always keep in mind with some of these companies that have went public in the past few years. Especially with if they're profitable, like Corsair Gaming, it's just a matter of time before they get into some of the bigger indexes out there. And so that's really good news. I'm obviously happy as a Corsair shareholder, and I'm sure everybody else is, okay? Now, look at this one. This one might be the most startling of all these I'm going to have on this list here today. Paramount. Okay, go Viacom. I mean, look at this one. Down 19% plus here today. So when it comes to this stock, first off, you've seen a move at 19, 20% on this one. And you're like, how is a stock like that? You can kind of understand that sort of move in a stock like Netflix, a stock like Shopify, high growth companies, right? But when it comes to this company, it's like, how is that stock moving? This is considered a safety stock. That's why I say there's never truly any necessarily safe stocks. There's stocks that are seen as safer. But even in this sort of market that's fear-driven, man, it's hard to find safety anywhere right now in this market, right? So look at this. The PE ratio is like a 4 on this company. It's insane. And it's a dividend stock. So it's a value play and dividend play. And so you're probably wondering, how does this stock move down? Well, I have some news for you, okay? So essentially, they're going to end up, this company is going to end up ramping up the media company's earnings, miss, and move up rampant investments in streaming. It raised questions on if they can stay profitable in this situation, okay? Viacom CBS said Tuesday it would invest more than $6 billion by 2024 to create new content, $1 billion more than it had previously committed. Now, let me explain why this matters so much for this particular company so you guys can identify something like this in the future, because I'm sure a lot of people like to buy dividend stocks out there, right? Or value stocks, and like to look at some of this and like, oh, this would be a safe play, right? Well, when it comes to these stocks, think about the type of investor base a stock like this, relies on. Who actually owns the stock? People looking for quote unquote safety, right? And profits. And the way the shareholders view a company like this is that's our money coming in. And if all of a sudden you're a company like this company, right? And you say, you know what, we got to spend a fortune over the next few years on all this content, all these things. The shareholders that are part of this company are like, okay, you go ahead, do that. Bye-bye. I don't want any piece of this, because they're not looking for that growth. If they were thinking about, right, like, hey, we were going to grow the business, we're going to spend a bunch of money, those people would be in Netflix stock, not in CBS stock. So the way folks look at this is they say, you know, if you're going to spend all that money, count me out. Count me out in this situation, because I'm here for the big, huge dividends. I'm here for this low PE. And if all of a sudden you're talking about you're going to try to do all these things to grow the business and whatnot, I'm going bye-bye. Now, some folks might say that's kind of ridiculous and you should hold a stock like this, or if anything, be buying in this situation. The company's investing into their future. And I would generally agree with that, but you got to understand the shareholder base there. And you all of a sudden get this moment where people are like, nah, I'm good. I'll go find another dividend stock to put my money in. That's exactly what's happened here today, where this shareholder base is like, I'm out. I'm out of this. And you see a similar phenomenon happen with growth companies when they stop growing at a high rate and they start becoming what's called a value stock, where they can't put up their same type of growth rates. Even Meta's going through this recently, right? Where they brought down growth rates big time. Now people are looking at Meta and they're like, wait a minute, you're not this big growth company anymore. Now you're a value company. You kind of get in this weird, you know, you can't keep your shareholder base happy in a situation like that, because you have certain shareholders that expect certain things. And if you can't give them that, they're out. They're going to find another stock to buy. And that's how you get one of these stocks that's an insanely low PE name, a great dividend company, you know, established business model for decades now, and you get it to sell off 20% today. That's how you get it to happen. You change, you know, the shareholder base, and folks just say, peace, I'm out of here. And that's exactly what happened with that one here today. Look at Wix here today. This one's down 23%. So the reason this one's down so much is they said they couldn't forecast numbers for 22. Now, in their defense, they're not the only company that said they can't forecast companies. By the way, look at the 52-week range on this, $362 to $81. You know, these moves, by the way, we're seeing in a lot of these stocks, guys, these are reminiscent of the tech bubble days. There's no doubt about it. I mean, you're looking out at these stocks, you're seeing them 60, 70, 80%, 90% down. You know, this is like what we went through in the tech bubble. The one big difference is these companies actually have real legit business models, and it's not just some pie in the sky type stuff like, you know, was going on in the tech bubble days when it was like, oh yeah, some website that, you know, was going to be big someday, and it never ended up being anything. Like with these companies, they actually have real revenues. Most of these companies are doing hundreds of millions, if not many, many billions of dollars of revenue. Some of them are profitable companies, or you know, right around that range of going to profitability in the next year or two. And they're getting absolutely devastated like these stocks did in the tech bubble days. And so with something like Wix, you come out and you say, hey man, we can't forecast our numbers for 22. Shareholders are quick to hit that sell button right now. I mean, look at this stock. It was all the way down to 81 at one point today. And once again, the 52-week high is $362. Folks are just very, very, man, you do anything wrong right now, sell. It's like, you know, you do anything. You know, they're looking for just a little something. If you miss a number here, you know, don't quite hit your guidance, you can't forecast numbers, they are quick to hit that sell button right now. The big fund managers are. And keep in mind, this isn't like retail investors all selling the stock, and that's why it's down 23%. Believe me, this is big money, you know, just saying, I'm out, see you out of this one, okay? And that's the market we're in right now. Look at Fiverr. Fiverr, I couldn't even find any news for Fiverr today. And the stock's down 10%. Look at this one. You know, $68, it's been down to recently. $325 was a 52-week high. You go back, you know, basically at this time last year, Fiverr was a $320 stock. $320. And here today it's trading at $76 a share. This is what I talk about, man. We're essentially, we've been popped. That's all I can say about that. This market has been popped like it's nobody's business. It's, you know, it's so reminiscent of the tech bubble. But like I said, if Fiverr's a real business, Fiverr's going to be a much bigger company in 5 years from now than they are today. And yeah, that's a funny thing about this. We've had these stocks completely get decimated like we did in the tech bubble, right? But the main difference is these companies actually have legit underlying business models and aren't just some pie in the sky dream type things, and actually have great revenue growth and big numbers to report. And but right now in this sort of market that's fear driven, man, You don't even get any news and your stock goes down 10%. That's incredible, right? Affirm, I've just been tracking this one recently. So obviously they reported troubling earnings, or at least was seen that by some as troubling earnings. Some of the numbers were really good, but some people didn't like other numbers. Let's put it that way. Look at the stock, $43. It still hasn't found a bottom yet. It hit a new 52-week low here today, 41.86. And this is that company where you buy something now, you pay later essentially, and they're partnered with a bunch of companies. But when it comes to Affirm, look at the stock just a few months ago, $168 a share. Just a short few months ago, and today is $43 a share in a matter, like, that's a snap of fingers, right? Incredible. It's another 52-week low, and these stocks are just, anything that is higher growth, money losing, these are the stocks that are getting extra hit. But I want you to keep this in mind, okay? It's not just those stocks. We looked at CBS, which is a profit machine, and that one got hit. Meta, look at that one's had trouble. That's a cash flow and profit machine. PayPal, look at PayPal. That one's still trying to find a bottom. That one is a cash flow and profit machine. It's going to be a much bigger company in 5 years from now than it is today. And yet these companies are just getting hit day after day after day. It's nothing short of extraordinary. There you guys go. You knew you were going to have to hear it at some point in this video, okay? Roblox. All right, next one up. Rblx. Roblox. Look at this one, okay? It missed on top and bottom lines despite having revenue jump 83% year over year. That's incredible revenue growth, by the way. Revenue came in at 568 mil for 604. Right there, give me a break. Wait, you're done. You're done. You missed a number like that right now in this market. You're done, dude. You're done. Bookings, 770 mil versus 786 was expected. You're done. Losses came in worse than expected, 25 cents versus 11 cents. You're done. What do you think happened to this stock today? Rblx, 27% down. You had $100,000 in a stock, last night, right? $100,000 in a stock last night. This morning, you woke up and you had $73,000 in a stock. That's how fast it happens, right? And this one, new 52-week low, $53. This one was at $134 on November 19th. I mean, these moves are vicious. I mean, just nasty when it comes to these sorts of, companies right now. And where does it stop? No, on the bright side, look at Upstart. Okay, Upstart is an artificial intelligence company that tries to use artificial intelligence to make lending decisions and give loans and those sorts of things. Okay, Upstart. This one, it's having a great day today. Great day, 32%, massive. But do keep in mind, this was a $390 stock a few months ago. On October 15th, this was a $390 stock. Check out the 52-week range on this one. Anywhere from $401 to $42 a share. Talk about a 52-week range. Oh my gosh, okay? And so when it comes to Upstart, it's one of those high-growth companies, but geez, a lot of folks are looking at this one. They're like, well, that's a huge move, but who's to say it's not just about to lose that whole huge move? And it's definitely a possibility. Also, a lot of people worry about a business model like this. If we were to go into any sort of recession scenario, a lot of people are like, how's Upstart really going to hold up in that sort of environment? And so, yeah, it's having a great day, but do keep in mind this stock is still down, way, that's like, down 60%, if not over 60% from where it was just a few months ago. So do keep that in mind. Now, I look out there and I see, large cap stocks getting devastated left and right? I mean, it doesn't matter what it is. It seems like it's getting hit hard. The market got lucky that Apple came through and Microsoft came through in a big way to basically kind of save the whole stock market, to be honest. If those ones didn't report such insane numbers, and specifically I'm talking about Apple, I would say we'd probably be 5%, if not 10% lower on the S&P 500 and the NASDAQ 100 than we are right now. But those stocks held it up, held this whole show together essentially, and gave at least a little bit of positive vibes. Now, if I think about the way I'm positioned in this market, to be honest, okay, and I know I've gotten a lot of crap over the past few months on the stocks I've been loading up on heavy over the past few months, okay? To be honest, I feel very, very comfortable with the sorts of positions I'm in and where I've positioned myself in this market. In the type of business models I'm in, I feel very, very comfortable in this sort of market. Is it possible my stocks fall? Sure. Is it possible Tattooed Chef falls on earnings or Honest falls on earnings and whatnot? Sure. Those things are possible. I'll just obviously be a buyer in those situations. But I think about myself in the way I'm personally positioned in this market. It's exactly where I want to be positioned in this market. And the way I kind of see this playing out, is I'm going to be likely hiding out in a lot of these sorts of stocks I'm in for a while. I see myself, potentially a year, maybe even a couple years, maybe even 3 years, 4 years. And I see myself eventually starting to get more into the big caps and some of the mega caps, a little bit later on down the road. But right now, I really like the way I'm positioned in this market. I see small caps consistently looking very, very healthy. I see the Russell looking very, very healthy in terms of its outperformance of the markets consistently the last couple of weeks. And so I love the way I'm positioned. I think once we get a bottoming out in the market and we kind of get out of this fear cycle, I think the Russell is going to be the one that actually performs the best. I think S&P 600 is going to perform phenomenal. I think a lot of the small caps are going to weigh, and I'm not talking about a small outperformance. I'm talking about a massive outperformance. I do see opportunities in the mega caps now. Let me be very clear about that. Stocks like Meta, which Meta, you better have a long-term outlook because they're spending a fortune right now in Metaverse, and they're not going to get much back from that for the next couple of years, okay? So you better have a long-term outlook with that one. Don't hope that suddenly at this time next year, Meta is going to be way higher than it is today. That could be dead money for a bit, but that one's still a great value. PayPal's a great value. That one I do expect to have a next couple really, really good years, but that one's an extraordinary value right now. Netflix even looks pretty darn appetizing, and I never thought I would say that about Netflix. Amazon looks pretty good right now. There's a lot of stocks I look out there and I see a lot of good deals. I think Shopify looks pretty darn appetizing now. It's not necessarily the best value in the world, but at the end of the day, like Shopify is one of the very few companies that I can see as being like, if we look 8-10 years in the future, it's one of the very few companies I could see being a company that's doing $30 billion, $50 billion of net income and become a $1 trillion market cap type company. And I don't see a lot of those out there in the market that I could really see getting to that sort of level. They're one of the very few, okay? So there's some real opportunities opening up in these mega caps now that we haven't seen in quite some time, but I really, really like the way I'm positioned in this sort of market, and especially when I see all these tech stocks tanking left and right, and I'm hiding out in food companies, in diaper companies, and those sorts of stocks. I always stay invested. I might rotate a little bit. There's certain time periods I buy a little heavier. Certain times I buy other sectors or industries a little heavier than others, but I really like the way I'm positioned. I think I'm going to end up massively outperforming the market over the next few years. And time will tell when it comes to all that. But I really like the way I'm positioned. Let's just put it that way. So anyways, guys, much love as always. Hope you enjoyed this. A video like this where we're looking at a bunch of individual stocks. Let me know if you did in that comment section. And I'm sure I got more content coming for you guys in a bit. Peace.